Generally, you can use any state's plan if you're doing sort of the vanilla 529 plan that everyone's probably thinking about. There are other types of plans which are sort of called like a tuition credit kind of plan, where you would be paying for a credit that allows you to go to some school that the plan allows you to go to. And the concept is you're locking in today's tuition rates. So you'd be buying a token or at least a portion of your tuition today for then the child to go when it's time. They haven't been widely used probably because tuition has skyrocketed and it has gone up much, much more than the investment assets have gone up. So a lot of the programs just have very severe limitations on the schools you can apply to. For the most part, those kind of plans they're limited to residents of that state and to go to the in-state schools, and so they're there, but they're allowed. California does not have one of those kind of plans. They only have the 529 that everyone's probably thinking about, which is just sort of a tax-exempt or tax-deferred at least vehicle. So a 529, big picture, it works a lot like I guess it functions similar to a Roth IRA, where the assets will grow tax-free, and as long as you use them in the right way, you don't pay tax when you use them either. Again, each state will have limitations on how much money you could put into one, how much even money per year you can use, but for the most part, all of them, they all function the same, which is to say that you're looking at using the assets for qualified, I guess the term of art is qualified higher education expenses, which traditionally was envisioned to be tuition, room and board, equipment, supplies, pretty much anything you could justify as a necessary cost of going to school. The Tax Cuts and Jobs Act broadened the definition of qualified higher education to now mean elementary school and middle school tuition. So it's limited to tuition. So they didn't change the word, so it's still qualified higher education, and you can now apply that towards your elementary and secondary tuition, which, just sort of as an aside from a planning perspective, you're not getting much out of it. The general concept of the 529 is it grows tax-free, and then you can use it tax-free. So if you're putting money into your 529 to use for your child's preschool, as expensive as it might be, you're not really getting the benefit of what the plan is all about. So,
but if you prepay 5 years,
right,
husband and wife, that could be quite a bit.
Yeah. So the gifting. Yeah. So so the comment or the question was about the funding of the 529s. So as was mentioned, the 529 plans you can front load with up to 5 years of your gift tax exemption, your annual gift tax exemption, which is currently $15,000 per person per donee, and that's per year. So you can do 5 years of that, so $75,000 you could put into a 529 with no gift tax consequences whatsoever, and a married couple could double that to $150,000. And then again, this is per donee. So in theory, if you had a lot of money and you're ready to put it all into 529 accounts, if you have 6 grandchildren, you could put, between a married couple, $150,000 into each account. And but what you have done is you've used up your gift tax, your annual gift exemption for those donees. So technically, over the next 5 years, you're not really supposed to give them any more gifts because you've already maxed out what you can give them. In order to do that, you also you check this on a gift tax return. So you do have to file a gift tax return, and no matter how much exemption or annual exclusion amount that you use, you have to prorate it over 5 years. So I should say, as long as you've used up more than 1 year. If you use up only 15, you wouldn't file a return. But even if you put, $25,000, you would need to file a gift tax return, and then it would be treated as if you spent $5,000 each year, and you would have to keep filing that gift tax return to keep claiming the $5,000 towards it. So there's an administrative headache to doing it, but that's how it functions. And again, there's strong tax benefits for doing so, and as long as it's used. Let's see how much more time we have before I go too much further. So the other benefits we'll cover, because these are actually pretty tremendous benefits, and they're sort of against a lot of what the tax code tends to do. So 529 accounts are very, very flexible in that if you are the account owner, which is as in you created it, you can pretty much do anything you want with that money. You can even reacquire it and just, you pay a penalty, but you can, it's not mandatory that it goes towards that child's education. Similarly, you can change beneficiaries so that if one child just doesn't go to college or doesn't use all of the money, you can very easily switch that fund over to a different beneficiary. I generally say child, but it also, you can create these for any person. They don't have to be related to you, although there's little reason to do it necessarily, but you could. And so they're interesting animals, and the IRS gave a lot of leeway towards the definition of a gift is. I guess for planning purposes, I should also mention though, if you are using annual gift exclusion to fund them, and then you're reacquiring that, you're just sort of wasting what could be a really good wealth transferring opportunity. But a lot of what 529 plans are less for wealth transfer and more for just promoting getting kids in college. So there's obviously ways to take advantage of every tax program, but this one's not designed in that way necessarily.
Who's in charge, and how is that, how does that succession occur?
So the question is, who is in charge? So there has to be an owner at each time or at all times, and that owner would then be the one who's controlling things. When you're in a 529 plan, at least in terms of investing, you're limited to whatever investments that they offer you, and that's then where the state shopping comes into play. So in terms of actually controlling the investments, for the most part, it's always going to be mutual funds and generally common investments. And switching owners is, I believe, pretty simple. I didn't look into that specifically, so I'm going to have to get back to you on there, but they're very flexible devices. You could also own them in a trust if you want. The owner could be a trust, but there are some downsides to that, such as the ability to reacquire those assets goes away if the trust is the owner. And there's some other minor reasons. There's little reason to have a trust as the owner, but you could do it.